1 rupee and had a cup of chai. What do you call it? Cutting chai? What do you call it? Yeah. Right? You call that. Okay. So you took, so 1 rupee, let's assume the price of chai is 1 rupee in 1990. Reasonable? You take the other rupee and you tell yourself, I'm going to invest this 1 rupee, the other 1 rupee that I have, so that I can buy myself a cup of tea 25 years later. Is that alright? So, what do you think is the, Ashal talked about inflation, what do you think is the rate at which the price of tea has increased over the years? Percentage. It's about 13 to 14%. So, that 1 rupee that you had invested in 1990, if you, so you have invested it somewhere, you redeem it, pay some tax on it if applicable, and then you go and get yourself a chai. So what should have been the return? No return. What should have been the, no, it's hypothetical, right? So
more than 30%.
Exactly, after tax. Is that alright? You understand? If that investment had not grown more than the rate at which the chai prices have grown, you would not be able to buy chai after 25 years. Now you recognize where should your comfort zone be?
You should be able to build the inflation.
It should be such that my goals can be met. He said that he nailed it perfectly. That's it. There's no better way to say it. So the problem is my comfort zone in fixed deposits. My comfort zone is real estate is that you're looking at products first. We should adopt a product's last approach. The product should be the very last thing that we should look at. So until that comes in, I'll use the board. I have problems with these easels. Every easel that I have used, I have pushed back, and it fell right in the middle of the cup. I don't know why. Can you see from here? Is it okay? Yeah.
Light.
Which light should I put on? Turn off first.
Yeah. Lights are on there.
So let's have some examples of asset classes. What is an asset class? What is an asset class? An asset class is something that you can invest in, but it has got a very distinct risk and reward profile. Do you agree that stocks are different from fixed income, fixed deposits? Why? Because of the kind of returns they give you and because of the kind of volatility that they exhibit. Agree? Gold is an asset class. Again, because it's different. Silver is an asset class. They're all different asset classes. Well, you can call gold and silver as commodities and fix them as assets. So, instead of looking at products first, the key aspect of building an investment portfolio should be what is asset allocation. So, what do you think asset allocation is? Right, so suppose I hold 100 rupees with me, that's my net worth. Out of this 100 rupees, how much is put in stocks? How much is put in gold? How much is put in fixed income? This percentage breakup is asset allocation. And this asset allocation is, in my opinion, the key to building an investment portfolio. Not the products, not the kind of returns that we just take your time and keep going. So, in order to understand what asset allocation is necessary for our aspirations or our goals, there are two questions that we need to answer. When should we invest in what asset class? Otherwise, you can make mistakes. Agreed? The second question is what return to expect from each asset class. Now, I haven't included. It's on. So, okay, great. So I haven't included any of my results in this PowerPoint, but I can provide you links and also there are calculators available. So we have to answer two questions. When should I invest in what? And what is the kind of return I should expect from each asset class? Now I have a calculator for this, which is given by the red title, deciding on the asset allocation for financial goal. I'm going to describe this process to you, but you can use that calculator to feed in inputs necessary for your goals and come up with an asset allocation. Sorry, I hope I don't pull it. So these are some broad recommendations. The reason for this, I have a post on how to define long term and short term. There I have described my research on why I think these are so. And the good thing is, Ashal more or less naturally agrees with me. We have never disagreed on investment risk return in general, which I'm lucky to. If he disagrees is a problem, but he generally does not disagree. So suppose you need money within 5 years. My suggestion is, especially for people who don't understand or new to equity investing, stay away. No equity in your portfolio for any money that you need within 5 years, because it's too volatile, very difficult to handle it. And in the short term, volatility is equal to risk. There is no difference. So stay in fixed income avenues that you are comfortable with. How many of here are debt mutual fund investors? Quite a lot. And debt mutual funds are actually more complicated than equity mutual funds. Unfortunately, this is because a fixed deposit is very easy to understand. Is there anybody who does not understand how a fixed deposit works here? Right? Everybody understands. But the moment that fixed deposit can be traded, the moment it becomes market linked, all sorts of problems creep in. So debt mutual funds are more difficult. So if you are comfortable with debt mutual funds, great. Otherwise, good old fixed deposits and recurring deposits are perfect. Thank you. Yeah, thank you. Oh, this thing comes when I touch it. So good old FDs and RDs will do well. Between 5 and 10 years, financial needs between 5 and 10 years. Equities are still volatile, still difficult to manage, especially by those who cannot manage risk. So if you're not comfortable, stick to 500% fixed income. Is there any problem in doing that? 100% fixed income? Are you going to lose anything?
Returns may be less.
But the money will get spent in 5-10 years. The goal will be over in 5-10 years. Inflation, see, inflation matters for 5 years.
Very low.
It matters or not?
Yes.
It matters for 5 years, but can you beat inflation within 5 years?
No.
It's possible. It's possible. I'm not saying it's not impossible, but it's possible that you might get a loss also. Right? In trying to beat inflation, you take on more risk. So within 5 years is difficult. Within 5 to 10 years, which is an intermediate term, again it's very tricky. It requires a little bit of experience to attempt this. So I'd say this: if you are not comfortable, stick to fixed income. Otherwise, you can add a little bit of equity in your portfolio. So these are. Do you recognize that these are examples of asset allocation? Yes, I'll show you how to get to a return expectation from that. Anything above 10 plus years, equity will still be volatile. Equity will always be volatile. Volatility is the only constant in the equity market. It can be mathematically shown that the amount of volatility is the same whether it is 3 years, 30 years, or whatever the duration. But risk can be managed, that volatility can be managed with minimal effort. That's all I'm going to talk about. in order to beat inflation?
Yes.
Is it a must?
No. High probability.
No, I'm saying suppose my comfort zone is fixed deposit. I don't care all these stock market fellows, they're all gamblers. I will. There are people like that. You agree? There are people who say that. I will stick to only fixed deposits. Is there no way I can beat inflation by investing only in fixed deposits?
Spread the.
No spread. I want only FD, sir. I like just FD. I'll buy a 10-year FD. That's the maximum FD I can get.
You can, only the principal note will be humongous.
It is all perfectly fine for somebody to say my comfort zone is fixed deposits or fixed income. I'm not an AMC person to say, oh, you are not financially literate. I don't care, right? It's your comfort zone. But what should you do to offset inflation? Invest a lot more. That's all. It's your money. At the end of the day, we are all going to go and we are not going to take away anything. So you invest where you are comfortable with. But make sure you can drink the tea after 25 years by investing more than 1 rupee. Agreed? To drink that tea 25 years later, you should not invest 1 rupee, you should invest 15 rupees so that it also devalues and gets that comes to current tea cost. That's all. So you understand, right? There's no free lunch. Sorry.
Inflation will affect the cremation cost also after 25.
Not your problem, sir.
Somebody expects you to leave that and go.
I am very clear. I am going to donate every possible usable body part to a research.
They should not curse us. No,
Usable body part. Unfortunately, the usability is decreasing. That is devaluing every time. What do you do? 100% equity is also fine. There are people who do. He said, Subra likes 90% equity. Point is, what is the 10% debt worth? If it is 2 crores? That's not what I'm saying. No, it could be. I have no idea. I'm not saying that.
And he also tell us.
He won't tell exactly. He won't tell us. But the point is, Subra says this often. The asset allocation that will make you sleep comfortably is the right asset allocation. I 100% agree with that. But you must take an informed decision. If I want to be in FDs, I must compensate for loss of value due to inflation by investing more. Not many of us can do that. That is the fact. Right? We have to accept that also. So I'm sorry for making these recommendations without data, but I don't want to scare the beginners here by showing data. There are posts on this again. Now, the other thing I want to, while we are here, there is a very strong selling point about mutual fund SIPs, and they are being missold. Piyush Khatri wrote a new post, it was posted. SIPs are new ULIP. I agree completely. SIPs are being missold by saying, if you are disciplined and invest in SIPs, month after month, through the ups and downs of the market, everything will be alright. If it is not alright, it is not over. There's a huge mis-selling going on because SIPs offer a regular source of income for distributors. Please recognize that. And therefore, by selling you and making you, let me use industry parlance, by hand-holding you through thicks and silver, the distributor will earn a constant source of money. Agreed? So, please do not assume, I can show you, I don't want to scare away people here. Please do not assume that over the long term things will be alright. It will never be alright. Unless you know to manage risk, do not invest in equity. want to. I have this. Yes.
The risk here you're talking about is volatility.
Volatility, if not managed, will result in real return, real losses. That's what.
The risk is only the volatility you're talking about.
Yes, if not managed. All right. Now, what to expect? Ashal made this point. Both Ashal and I are 10% people. We belong to the 10% club. We only expect 10% from equity. I get this comment. What? Only 10% from equity? Corporate FDs give 10%. Why should I invest in equity? The reason I expect only 10% is I can invest much more. I force myself to invest more. Can you explain that? If you have used the goal planning calculator, you know what I mean. If I exactly
R is low. In your expectation, if R is low, you are bound to increase your P. Both of us are doing same. If you imagine R high, it will give you a kick that with lower P you can create A. But this R is not in your control. You may get it, you may not get it. So what both of us are doing in our personal life, we are trying to increase as much as possible P. Due to personal condition for last few years for Pattu, due to his health and mother's health problem, and in my case for last three months due to my transfer, this P is coming down actually. That is another issue.
So, at best, 10 to 12% is very reasonable. I have seen financial plans at 18%. 6% inflation. Let's just take numbers which are very comfortable for us, so that the client stays with us. 6% inflation, 18% return. There is a blogger who says retiree can invest 100% in equity after retirement and expect 18% return. Well, the person who just left knows that name. I don't want to.
I just wanted to say something. So there was this story with Charlie Munger. So one of his friends, he was a hedge fund manager, and he asked, and when he said, what rate of return do you promise your clients? He said 20%. He said, why? That's absurd. But they wouldn't give any money otherwise.
But that's precisely, that is exactly what's going on. That is the kind of mindset that happens.
They're talking all SIP is LBS taking stairs every day.
SIP is a new EMI. You know? Good EMI. Good EMI. Yeah, sure. Thank you. This is nice. This is mine. SIP is a good EMI. Yeah, that's right. So I would expect 10-12%. My past studies have shown that maximum 14% after beyond 10 years, over a 10-year plus region. All these expectations for 10 years. Below 10 years, coin toss. You can do whatever you want. I don't know. Because the volatility is so high, the returns. If an expert investor like Sundaram sir, he can beat inflation with fixed income. But for mere mortals,
Not can. He's already beating.
beating. Yeah. He's already beating. I just get myself. So he's already beating inflation. So for others, it will. Thank you. It is something like 6 to 8% is a very conservative estimate post tax. 6% is better post tax. You just assume current FD rates for 30% slab if you are in the 30% slab. Gold. It's a horrible asset class. It is as volatile as equity and gives you a return which is similar to fixed income. So over 10 years you can only get that much. 10 years plus. Anything less than that, it's a horrible thing. The sovereign gold bonds, which the government is, nobody knows what you will get after 8 years. Don't touch the bonds unless you know when to trade them at the right time. Otherwise it's a problem. You don't, so these are the rough return expectations. Real estate, we can sit and dream whatever we want. When we go to the market, we'll get something else. I've seen people say 1 crore at home, 70 lakhs outside, and then it goes down. So it's there's no index for it. And this is something which is quite important. What is the expected portfolio return? So we are now building an investment portfolio with a specific asset allocation in mind. Does anybody have a problem with that statement? We are building an investment portfolio with a clear asset allocation, and what is the expected return from that portfolio? So let's say we have 60% equity in our portfolio, we have an expected return of 12%, 40% of fixed income and 7% return. And so the portfolio return, the approximate portfolio return is the weight 60% times 12% plus 40% times 7%. Is this equation complex? Is there anybody who does not understand this? When I wrote this and when I had a...
If you are investing 100 rupees, out of 100 rupees, 60 is going into equity, 40 is going into fixed income. That 60 rupees is earning 12% equity rate, 40 rupees is earning 7%. So 60% of 12 means 7.2 rupees for that 60 rupees. And 7%, that means 2.8 rupees out of that 40 rupees, making it a total of 10 rupees.
So, by fixed income, you mean not fixed deposits, right? You meaning debt funds.
It can be fixed deposit.
Anything which are debt funds are fixed income products, but they're just market linked, that's all.
Yeah, but even your fixed deposits, even if you are a higher tax bracket, for example, or any tax bracket, you get worse returns than a...
Yeah, it depends on you. And this is only an illustration of weighting your, that's all. You can input whatever you want. That is why, sir, I deal in calculators. I only produce the tools. What you put in is your... Yeah, that's okay. I know it's a little too close. Sorry, my nasal tone is. So that is the again that's the title, deciding on asset allocation of a financial goal. So this tool will do this calculation for you. So given your inputs, given for a specific goal, it will tell you what kind of portfolio you should expect after tax. Please recognize. Post tax is applicable also for equity. You don't know when the rules will change. Today, long-term capital gains are tax-free. We have no idea. So always keep that in mind. It's a change variable thing. Every year things will change, and you'll have to change your inputs as such. Now, the key concept which many people do not understand is that asset allocation will change with time. Let's say, see for example, I started investing for my son's education about 6 years ago. I started with again 60% equity and rest in fixed income. Today he's in first standard, right? I need this money when he's in 12th standard. You agree? After he finishes 12th standard. If I keep this 60%, maintain the 60% equity all the way through, do you agree that's a risky thing to do?
Yes.
So as he goes to 6th standard, 7th standard, 8th standard and so on, I should decrease exposure to the volatile asset class. So I should taper it down and increase my fixed income allocation so that I have money, he mentioned this in the morning, in safe asset classes when he reaches 12th standard. Is it alright? I should have some kind of a plan on paper. This is of course a plan on paper. Things can be very different. Again he mentioned this. For example, when he's studying 8th standard, if equities get you a bumper return, take it. Take most of it out and put it in safe asset classes. Right? So you have to play it by the year, you have to take it, review the situation year after year. But even then, it's better to have a plan in which the asset allocation will change with time. When the asset allocation changes with time, what will also change? The amount of money that you will invest. Do you agree? It will affect the amount of money that you have. So I have a calculator for this which you can. I have a calculator for. It's annoying to say that.
But you should just tell them what you're referring to. The location of your calculator.
Oh yeah, that's the title of the post. I mean, I can, if you search for that within the blog, you should get it. Hopefully in Google also. Hopefully. So I have this flexible asset allocation tool where you can decrease the asset allocation and see the kind of money that you have to invest. Of course, this
plan, but it's better to have one than not. Okay, this is something. A few days ago, I had a very interesting talk with Pranav Surya. Pranav Surya is a 23-year-old. He came to my house with Subra's Retire Rich book. How many of you have read that? Retire Rich by Subra? Very few of you. That's surprising. How many of you know about it? Right. Okay. So he came and he had a list of suggestions for me. So I was talking to him. You are only 23, and so you can be retired in another by the time you're 35 if you like it. He said, I'm not interested in retirement. I'm not interested in that kind of. So I asked him, what are 20-somethings interested in? What are people in the less than 30 interested in? He said they're not interested in loans, getting a loan to buy a car or a home. They're interested in experiences. They want to take short trips. They want to go on treks. They want to enjoy life that way. So here, in my opinion, a set of solutions for that kind of thing. I would suggest find out what percentage of the take-home pay is left after monthly expenses, mandatory monthly expenses, for example, petrol and so on. Or if you stay with your parents, then the core expenses may be taken care of by them. So what percentage is left? And if you can spare 5 to 10 percentage of the take-home pay for an investment that you will never touch unless your life depends on it. Is that possible by the less than 30-year-olds here?
Yes, yes.
Is that possible?
Yes.
5 to 10%. Assume that you will never touch it unless your life depends on it. The rest of the money you save for, don't invest, save for short-term needs. Have fun. That's all. Until you will continue doing this until you. That is a sophisticated way. Until you get farmer. Let me elaborate. Me and Pattu are prime example of farmer. What is the spelling?
Agriculture.
Whatever home ministry ordered, we just agree. Both of us are farmers. Agriculture. I am happy that my wife does not. I mean, she doesn't ask much, so it's just potluck. That's all. So, but otherwise I'm basically screwed that way. So there are a lot of people. I can tell you. I mean, I didn't know that so many different spouses exist and so many complicated situations exist. There are people who say, I say only spouse, not wife. Let's be very clear. The men are equally bad. So, you cannot do this. You should not. It's very obvious thing, and then the other guy will say, don't do it. So it's a mess. Well, only the married people can appreciate that. So this is what I started talking about, products last approach. I just jumbled my slides a bit. So back to where I was. Yeah, I finished all that and I just came to 20 somethings. So this is again back to 20 somethings. If you've just started investing, and especially in equity, please do not bother about what the portfolio is doing for 3 to 5 years. Just forget it. You can afford it. No, nothing will happen. No heaven or earth will break. Nothing. Just forget it. Keep investing systematically. Don't touch it. You're only 25, 26. At best, you'll be 30 when you look at your portfolio for the first time. You still have time, even if you have lost a lot of money, which is, in my opinion, unlikely. Because inaction is probably the best action. And for the rest of us, please delete that money control app. Oh God, that is a source of evil, I tell you. Huge evil. Please look at your portfolio only once a year. That's all. Does not matter what market happens, whether there are surgical strikes, non-surgical. Does not matter how market strikes. Does not matter. It will not affect your. Does not matter. Once a year. I do it in December. That's all. Unfortunately, I've automated the process. Every time I open my tracker, all the data is there, but I try not to do anything about it. The other most important portfolio management strategy is rebalancing.
let's say you start with 50% equity and 50% of fixed income. So now everybody agrees, understands what that means? Yeah. Sorry, I keep doing this. Sorry. So everybody understands what 50% equity and 50% debt means. Let's say you invest in the market, equity has gone up by 30-40%. You've got a bumper year. Do you agree that the asset allocation will change at the end of the year? Yes, it will be skewed towards equity. There will be a favor towards equity. If you keep going with that asset allocation, what will happen? The risk will increase. The risk will, whatever returns that you have got, that will be at risk. Do you agree? So, at the end of 1 year, after a few years of investing, once a year, look at your asset allocation and push it back to whatever is your intended asset allocation. Let's say 50-50 is intended allocation, and you find that there is 75% equity and 25% fixed income. Take some money from the equity portfolio and shift it back. Shift it to fixed income. If you rebalance it, you will preserve the fruit of your growth, whatever growth that you have got. And by doing that, you will lower the volatility of your portfolio. And this is one of, if you notice, I would like you to look at two things. One is the success of balanced funds. How many of you agree that balanced equity funds have done quite well? Yeah? One of the key reasons for that is they rebalance monthly. And also, you please look at funds like Quantum Multi-Asset Fund, Axis Triple Advantage Fund, Canada Indigo Fund. These are funds which invest in roughly equal amounts of gold, fixed income and equity. Roughly 33%, roughly, not exactly. Please look at the NAV growth. Each gold is extremely volatile. Gold is as volatile as equity. Equity is obviously volatile. Fixed income depends on what gilts are also. But if you look at the NAV, it's nice and smooth. The reason for that again is monthly rebalancing. Rebalancing is a very key aspect. Of course, fund managers can do it. The advantage for us is they can do it monthly, but we don't have to pay any tax on it as long as we stay invested in the fund. But if we, that's why I said don't do any rebalancing in the first few years, so that you have some tax-free units accumulated in the mutual fund. After that, you can rebalance without any problems of exit load or tax.
So which were the three funds?
Quantum Multi-Asset, Canada Indigo, and Axis Triple Advantage.
They'll get crores on Monday.
No.
Just try to understand this rebalancing thing with a basic example.
Triple Advantage.
All of you are aware, in a general, a balanced fund invests 60 to 70% in equity, okay, and balance 30 to 35% in debt, okay. Agree? What is happening in a balanced fund internally? There is an old saying, if you want to earn profit from the market, buy at low, sell at high. Agree or not? That is the simple formula to earn your money from share market. Buy at low. Okay? If equity is not performing and it is coming down to say 55%, what the balanced fund manager do? Will shift money from debt to equity to make it again back to 65-35. Okay? That is, you by default you just gave your money to a balanced fund manager, but due to reduction on equity side, by default your money is put into equity at a lower level. Agree? Now reverse case, if equity is performing super, this 70% becomes 80%. Now this time fund manager will sell and rebalance it towards debt. So buy at low and sell at high. That is the simple mantra to earn profit from share market, and balance fund is the prime example of this mantra. But majority of us do not invest in balance fund.
Hey, that is not true. That is not true. How many of you are here? Sir? I need you. Many.
PF allocation started in 1999, being an employee in a company, and equity investment I started in 2005. Already a 6-year gap is there. Okay. Then again, at that point of time, salary was very low and my own confidence in equity was very low. So I was having just 500 or 1000 kind of money monthly basis. So even in initial years, I was not putting enough money into equity. Another thing is, my salary was low, so overall net cash available to investment was also low. So due to this whole background, as of now, my debt is this, my equity is this.
Those are just approximate squares. Don't take them too seriously.
Approximate. So that means now you get the answer why Ashal is not putting money in PPF, why Ashal is not having any FD, why Ashal is not having any RD. Because already my asset allocation is more into debt side and I want to bring it towards equity. That is why I am not putting more money into debt products. Clear? Thank you very much. Yeah. Yeah, please. Uh-huh.
He doesn't need to. Because his desired asset allocation is equal area squares. So until the areas become equal, he doesn't need to. Same case with me. I have the same case. You mean he will not book profits?
Yes.
He doesn't need to is what I'm saying.
Just for example purpose, I am not giving actual number, just for example purpose. Say my equity portfolio is 6 lakh as on date and my PF is 10 lakh as on date. Now if equity now onwards in next 1 year performs brilliantly, this 6 lakh at best can become 8 lakhs, 9 lakhs, 50% return. That means another 3 lakh added into equity. So still it is 9 lakh. But in next year itself, due to continuous input from my salary, the basic 10 lakh will become maybe 11 lakh, maybe 11.5 lakh, and some interest on it, it can become again 12 lakh or 12.5 lakh, roughly. So still I am not towards 50-50 that I want to achieve. So still I need not to rebalance from equity to debt. Yes, after maybe 1 year, after 2 year, after 3 year, as and when my equity side goes to say 13-14 lakh into equity and 12 lakh into debt, and at that point of time I may start rebalancing. How I will rebalance, I will think at that time.
After that we'll ask.
But tell me one thing,
Yep.
when the equities are rising, if you sell it and put it in the debts percentage will be lower, percentage interest rate will be lower. How does it make a sense?
If an equity rise faster than the underlying earnings, then your forward returns will reduce.
Fair enough. So that's with rebalancing. So while we review our portfolio once a year, this is what I would recommend. At any point in time, we should know what our asset allocation is. Do you agree? We should know what the asset allocation is. We should know what the expected return from the portfolio is. Two things we have already seen. The third thing is, what is the net return of the portfolio at the moment? The net return. How many of you know this? The net return. That's very crucial. Do you know how to get this? You can enter all your transactions in a portal like Value Research, and that will give you the annualized return of your entire portfolio. Then you should know the net return of each asset class. What is the net return of equity? What is the net return of the debt portion? This again Value Research will give you if you create portfolios called debt and equity, or you can do it either way, any which way. And more importantly, what is the corpus worth? This is, to me, the most important point. For example, if suppose I have, let's say, 90 lakhs with me as my retirement corpus, what is this corpus worth? How do you answer the question? I have 90 lakhs with me. This is my retirement corpus. This again an illustration. 2 series. Because I have much more.
Good one.
I will.
Okay, so what is 90 lakhs worth? No, in the sense, see, the point is, I want personalized answers. What is 90 lakhs worth to me?
For how many years it will last you?
No. If I retire today with that 90 lakhs, if I quit my job, my nice cushy job, which I don't want to, but if I quit, how long can I live off that money? Does that make sense?
Should last more than my life.
You agree? If that money, if that 90 lakhs can, for my lifestyle, if that 90 lakhs is only worth for 10 years, and I'm only 42, so I only stay away from work until I'm 52. So it's not good enough. So that money should be 30 years or 35 years ideally. So that's what I want the worth of that corpus. So again, if I want to invest for my child's education, what is the typical engineering college fees here roughly? Can you tell me? 15 lakhs for a degree?
No, not
Roughly, I mean, roughly.
10 engineering.
10 mean a good college. Bad college means more money. Right? So we have to assume our kids are useless people. We have to put them in a third-rate college and plan for that. So let's say worst case 30 lakhs. Everything. Kid will want bike. He will want an Iker bike. We have to give him. All these sort of nuisances will come and they become turned. So 30 lakhs totally for college education, quote unquote. What do I have today? Let's say I have 20 lakhs today and my child is only in the 7th standard. Am I comfortable? My child is in 7th standard. Current cost of engineering education is 30 lakhs. I already have 20 lakhs with me. Is there a comfortable situation?
No.
No? Bottom line? Oh my God, that's being too severe here. Bottom line? I'm past already. I can manage. At best I can ask him to go take an education loan because that 20 lakhs will increase to at least 25 by the time he goes to 12th standard. So it's not so bad.
30 lakhs will also go.
I agree, but it's not so bad. So my point is, now you understand how you can gauge with this kind of personalized requirements. Of course, the aspirations of the child will also change. One day it is astronaut, one day it is a train engine driver, the other day, so every year it will change. You know what my biggest nightmare as a parent is? My child says I want to go to some college. I go to that college, pay the fees. 2 weeks later he says I don't want to do this degree. That is my biggest nightmare. And all the money I have spent is gone. This can happen. You agree? You cannot do anything about it. These are all difficulties. So the point is, it's very dynamic. All these inputs have to be put into our portfolio every year, once a year. So once a year we should ask when we sit down with the portfolio, beta, what do you want to do? So adjust. That's the only way. It's all dynamic. So that's what I mean by what is the accumulated corpus worth. Course corrections are necessary. So once you have new inputs, automatically you will know whether course corrections are necessary. And once you can answer what is the accumulated corpus worth today, you will not worry about what is the return. This is my experience, personal experience. So this will take time. It will not, first 2 years, 3 years, it will not make much of a difference. But with some experience, you will recognize that returns eventually don't matter. It's what you hold that matters. So this is something that I said already. As a deadline for the goal nears, get rid of volatile asset classes, go with something safer, and you will have to play it by the year. You have to take it year by year. For example, there is one recommendation by a US financial planner which is also valid for India. He says rebalance just before every election year. So this is US election year, so he would have asked his clients to rebalance now. Similarly, we should probably rebalance in January 2019. By then, who knows what scam? No idea. Anything can happen. We may even have a new PM. So probably so every time if you sense that there is excessive market volatility, not by reading Asana Elizabeth, that every day is volatile. For example, India VIX. How many of you know about India VIX? India VIX is a volatility index. If you notice any sharp movements, then there's some danger about what happens. I'm not asking you to immediately sell all your equity assets, but just to get a trend of what's going on, right? So that's what I did last time. I rebalanced religiously before Namo came to power. Of course, whatever he just said, equity moved further up after he came to power. So I lost some of my returns, but that's fine. At least I know that I'm happier that it's not. Of course, it came down also. These things you cannot see. If you are a person who regrets, stick with fixed income. Because before you sign the fixed deposit, you already know the return. If you are going to regret, then you will say today you sold the stock, tomorrow it will go up. Regret won't work with equity. It is a nightmare. So, again whatever I said, review inputs each year. And this is something I recommend. Invest systematically and track investment systematically, not the investment value. Am I investing 5,000 rupees every month or 10,000 rupees every month? Next year, have I increased that 5,000 rupees to 6,000 rupees next year when my salary increases? Please track investments, not investment values. We are wasting a lot of time tracking value and worrying about whether it is going up or down. If I can control this. This is in my control. And if that makes a huge difference, I can tell you from personal experience that it makes a huge difference. I've shown this before. This is my own portfolio, how it is going. Don't worry about the numbers on the left. That's only from one. It's a normalized value. Please see that the portfolio was red for 5 years.
Laser.
Yeah. Portfolio was red practically from year to year. For 5 years. Thank God I was not part of Asana Elizabeth. Otherwise, I would have been. My experience is, it is not about time in the market. It is not about timing the market. It is about capital in the market. If you have enough capital in the market and if you can afford to wait until the market picks up, when the market picks up, it will change your life. And my life changed. Bam. Okay, it's a fact. That is all. It just changed overnight. Whatever I was investing every month, the market gave me every day during that period. Of course, it will also take it away. That's a different matter. See, I'm saying you should be proud that you have lost 2 lakhs, 3 lakhs a day. That's because your portfolio should be that much higher. Right? So, as you grow, your risk appetite also changes. So, patience is very, very important. If you are not patient, I mean, to me people are, one day ask me, you are talking in personal finance workshop, what is your qualification? That is my qualification. I have patience. That is all. All the other things are not important. Calculators, that's all nonsense. If it is useful to you, it is because you made some use of it. I didn't ask you to use it. So this is just this. So just a couple of slides before the one side. People like to take pot shots at DIY investors. So let me take pot shots at them now. Alright, so couple of slides and have that finish. Before I do that, a social experiment. Let's say Pranav goes tomorrow to Asana Wealth and he creates maybe a fake FB profile just as an experiment. And he goes to Asana Wealth and writes, I am so and so. I've been working in the corporate for the last 20 years. My current net worth is 5.5 crores. I invested in real estate, stocks, mutual funds. I want to know if I am financially independent. This is a great forum. I learned a lot from this forum. Blah 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 blah. You know what will happen? First of all, Pranav Date will become Pranav Date sir. Sir, you're so inspiring, sir. Real life experience, sir. What are your stocks you're holding? What is the real
How did you manage all this thing?
This is just, I cannot fathom this. I mean, I don't understand why do people, we have always wanted solved examples, right? From the time
Guide.
we were students.
Guide.
I don't know what. Invest whatever you can systematically. Be patient and keep investing for a few years. Wealth will grow. Is there any disagreement here? The problem is waiting. No, my cousin gave me a very nice example. My great grandmother, I lived in a mansion, a big mansion when I was a small boy. I also love real estate. I don't have money to buy. I love real estate. I want to buy that mansion back. I cannot buy it. What do you? So we lived in a mansion surrounded by coconut trees. My great grandmother planted those coconut trees. I have never seen my great grandmother. She has never seen a single fruit from those coconut trees. That is the law of the farm. If you sow something, you will not get immediate results. Right? You have to be patient. I don't understand why we need to be inspired. We need to be inspired by our own discipline. I don't want to look at other people's. We have to chart our own course. Looking at other people's portfolios or methods don't help. So my last slide. Now, I asked you if you are a decisive person in the morning, whether you can take decisions on your own. This is something very, very key. If you think that you cannot take decisions on your own, you need professional help. The first thing that you need to know is that investment advisory in India is regulated. Not anybody can offer investment advice. Only SEBI registered investment advisors can offer investment advice. How many of you seen a Lord of the Rings? Very few people. Okay, imagine a marshland, miles and miles of marshland. The Indian financial services is like that marshland. If you don't know where you are stepping, you're out. There may be rattlers, muddy puddles, there is quicksand. If you don't know where you're stepping, you're gone. So, people and the financial services, they're plain immature. What they do not understand is, I may want to take professional advice, but I still need DIY skills to pick a good advisor. Do you understand what I'm saying here? I may want professional advice. I want an investment advisor to manage my portfolio. But who will I choose? How do I choose that guy? I need DIY skills there. For that, I need to know what the rules of the game are. I have a short list of 10 fee-only financial planners who only offer direct mutual funds. Even then, people want me to pick one fellow from that 10. You understand, right? I can sit and do hours and hours of study, whether it is a mutual fund or a stock. I can learn all valuation techniques. I can read all the books written by Buffett, whoever, all those guys. Ultimately, the final, when you click that buy button in your Demat account, you are taking a chance. You agree? If you don't have that conviction to take a chance, you need advice. So all you can do is clear obvious sources of conflict of interest. Get rid of any fellow who takes commissions from somebody else. The fellow has to work only for you. No commissions. Get a guy who will get a flat fee, not a fee which is a percentage of your net worth. Why? Otherwise, it will, as your net worth grows, the fee also will grow. You understand what I mean? Yeah, so that becomes a mess. And ignore all bloggers, including me. All bloggers are scum. They're just plain scum. Including, I have no problem saying this. Ignore any advisor who says, I'm a wealth coach. I will hold your hand or your favorite body part for a fee. Ignore all these things. You're looking at a guy who must be, down to earth. I'm controlling myself here. If it were my students, I'll start swearing, but okay. What is AFIW? Asan Ideas of Wealth. There is also an AF. Asan Ideas of Wealth. There's also Asan Ideas of Worthless Information. What is Asan Ideas of Worthless Information? The funds that Ashal holds. So no use to me. Excuse me. What stocks Indrani holds is of no use to me. There are services. Somebody is offering services saying, I will tell you what stocks I am holding for 7,500 rupees a year. I don't understand how that's useful. So, this is nonsense. So, and the other problem is, after choosing an advisor, please work with the advisor regularly. This is something that very, very few people in India do. First of all, most of them don't go to an advisor. They think they can DIY. Two, even if they go to an advisor, they don't work with them regularly. So, if you, please make the decision whether you are going to be a DIY or a